Hey everyone, and welcome to this episode of the Biometrics Leadership Lab Live. We are here to support you on your biometrics journey, giving you the tools and tips you need to move from lead to leader. And today I'm very excited to have Joel White here, and we are talking about his Q1 recap. Thank you for joining us live, and if you are watching a replay, thank you for taking the time to catch up. You can ask questions on the event notice on LinkedIn and we will see them. However, we can't respond in writing during the broadcast. So if we don't get to your question live, look for an answer in the comments later. Before we get started, we're just going to do some quick introductions. I am Amanda Cross, founder of Crossfield Coaching and Consulting, a biometrics and clinical data advisory helping small and mid-sized companies and teams manage data risk, integration, oversight, and governance. With decades of experience in clinical research from statistician to COO, I leverage my cross-functional experience and training to help teams have confidence in their data integrity. Joel, want to introduce yourself?
Yeah, so Joel White, you'll see market cap consulting associated with my name. That's just me. So I am primarily a pricing and finance consultant across the clinical research industry, particularly with service and technology providers. So just coming up on my 5-year anniversary of doing that. It's been a wonderful experience, and very happy to be here with you, Amanda.
Yeah, thanks for joining me. And I'm going to put on your recap on the stage here so everybody can see it. And I was noting in the comments when I saw it posted on LinkedIn, your 5-year anniversary. And one of the first things you talked about was Science 37, which is ancient now.
That brought up that brought up some memories. They're not on the recap anymore because they were taken out a couple years ago, and they are now owned by a company whose chief wellness officer is Tom Brady. That Tom Brady. So, they've definitely gone through an evolution.
Indeed, they have, as have clinical trials. If you haven't read the comments on that one, go read them, because I think what Science 37 was doing or attempting to do and the nomenclature around it might have been a little misaligned.
Comments were extra spicy this quarter. I loved it. It was great.
All right, so we're going to walk through the recap, and Joel and I are going to add some commentary to what's going on. But good news in the biotech funding.
Yeah, it's funny because I'm always learning. I've been in the industry 20 years and always hearing about what's going on with biotech funding, and it's hard to find where those things are. So if you see something underlined here, you have to download the PDF, but it's a link that you can click through. And so one of the things I learned this quarter was actually how to find the bio world numbers. There's a particular way to query it. If you don't have a subscription, and the numbers were just absolutely amazing. 1 month does not make a trend, but 4 months at least start to make a trend. And if you looked at last year, you're seeing excellent growth rates. So this is on the smaller to medium, biotech funding side, but the numbers were absolutely phenomenal. And the way I look at these numbers, Amanda, is that if biotech funding numbers are doing this, it doesn't automatically mean every CRO in the world is doing amazing, but there are trends that you would rather have going up than going down. And very few biotech customers have their own sources of revenue to pay for trials, so they rely on external financing. This is an excellent measure of that.
I agree, and there's a lot. I do a lot of work in small and mid-sized space on the CRO side, and so they watch this biotech funding quite a bit. So it'll be nice to see it trickle down, I guess. But as you say, it takes a little bit of time to make its way through. What do you think the breakdown is between like new study funding versus change orders?
No idea, but I know that it is definitely greater than 0% on change orders, and it comes through a lot more quickly. And change orders, I mentioned here expanding existing studies, but it can also affect things coming off hold, new awards that are delayed on getting contracts signed. All of a sudden, they're ready to sign the contract, and those contracts may end up having more scope than they did before. So all to say, a lot of the conventional wisdom, the commentary is that, hey, we got all this new biotech funding. That's great. It's just going to take some time to flow through. Well, most of it will, but not all of it. And so, having been the change order guy at CROs when I was in house, it was a signal to me that, you gotta have your game ready for the rest of this year. Not just the rest of this year. It's been happening. It's absolutely been happening.
If I'm not mistaken, that link is going to go to an article I didn't click this one, but I think this is going to go to an article you wrote on how to manage change orders and having change orders are around, if you will.
Yes, yes, yeah, yeah. Definitely click through to that, and yeah, there's a lot of good stuff there. I once was the change order czar. That was not my HR job title, but it was a very tough role, but very, very necessary in a turnaround situation where a lot of change orders had been lagging, and yeah, it's not pretty or beautiful to say, but a struggling CRO, one of the fastest ways you can turn around your financial performance is to get your change order shop in good shape for
Yeah, and
multiple
having
reasons.
dealt with those myself at a small CRO, they can languish or they can
Yeah.
grow and nobody ever puts them out. So it's a good way to go get some,
Yes.
I guess, low hanging revenue, we could say. This
Yeah.
is a little hard to see, but as a group, everything's looking good. But med device manufacturers, I've been selling off, so I'm going to assume that's this graph. It's hard to tell what
Yeah.
the scale is, but it makes me
Year
wonder
to, yeah.
if you're a med tech CRO, should you start to be worried a little bit?
I don't know. I don't know. I've put a question out to a guy I know who is able to get a read on med tech funding numbers, which is not necessarily the same as its stock price. You look at the med tech manufacturers on the right side. That's heavily influenced by the Medtronics, the Strykers of the world. I think Medtronic has acquired something like 3 or 4 companies in the last month. And they've announced that's their big spree. That doesn't necessarily affect what they will spend on clinical trials, but it was a pretty stark contrast to me. Now, in the larger world of CROs, what mostly matters are the left side charts. I think I once said that if medtech went up 10%, but drug went down 2%, just about everybody would be down. Right? It's much more influential on the drug and biopharma side. So, but you just look at the longer term trend, and it's up it's up and to the right. That's what you want to see. The biotech funding on the previous slide, that's partially affected by this, but this also is just the equity performance, and the stronger the equity values of these types of companies, the more they can raise additional money, and or have confidence in releasing existing money towards funding more trials. Companies like Lilly, who are also on an acquisition spree, they're more confident in doing so if their share price is at a good level.
Lily, do they have a preferred arrangement with a CRO that you know of?
Oh yeah, yeah, yeah.
Yeah.
They don't really disclose it anymore, but when it was just quintiles, quintiles would talk about. They used to have this metric. I wish they still had it, of the number of customers who generated at least $100 million a year through them. This is going back in time, and yeah, Lilly was one of those forever. Probably still are, but I'm talking like back to the '90s.
Yeah.
Yeah, very long. That's just one example of Lilly spreads its bets through multiple CROs.
All right, now we've got to look at the CROs, and they are all down.
Yeah, yeah, not today. I'll tell you what, on the back of Icon reporting its results, Q4 results last night, and having a good call this morning, a very long call. Yeah, things are spiking when I checked right before this go live, but this is all scaled year to date, I believe. And you see most of them get hit there. What, in that February timeframe? That was when a lot of industries that were seen as, especially software, which is ironically not CROs, especially software, they were getting hit by the concept that AI was going to start display. It would, at a minimum, jeopardize the long-term growth rates of various industries. And then some of the scaremongering was around, it could happen this year. It's already happening. And so on that left side, you start seeing that, in combination with Icon announcing an internal accounting investigation, which is very rare in this industry, Amanda. The last one I could remember was Syneos receiving an SEC investigation notice, might have even been 10 years ago, around its backlog reporting practices, and nothing came of it. But yeah, so the combination of these things, which called into question CRO reporting practices, yeah, really hit things on the left side, but they haven't, really rebounded
So,
very well. So the point of all this was that, okay, there's so many good things I'm seeing, but what you're seeing in these charts is the cumulative impact of a lot of large institutions. This is not your Uncle Joe putting 100 shares of Charles River in his 401k, right? This is, these are pension systems, pension systems, large institutional investors making billions of dollars worth of investment decisions. And so far this year, they're saying, CROs are not for me. So, um, yeah, so that just all, those are all just data points in my brain.
there's a couple things there's one thing I'm going to pull together, a couple pieces of information, some of which are later in your recap. But just so people know, we've got IQVIA, Icon, Thermo Fisher on top, Charles River, Fortrea, and MedPace on the bottom. And MedPace is the one I kind of want to talk about because um, regardless of your view on MedPace, the investors really tend to like them. And here, they're kind of even struggling a little bit. It's all relative, of course. But later on in the recap, you talk about MedPace as being historically very strong in the cardiovascular space and potentially some shrinkage in that market.
Yeah, these are all scaled year to date. And so, this year, MedPace has been getting sold off this year. If you zoom this out to a 2 to 3 to 5 year time frame or back to their IPO several years ago, the longest term investors love them and have been very handsomely rewarded. So, but yeah, some pressure this year. Mixed messages on what it comes from, but MedPace coming into this year was vastly outperforming their publicly traded peers on growth rates. they they still are, but you get this book to bill metric, um, which seems to be a culprit, and investors reading into that, which could be valid. I mean, you just won't know until next quarter and the quarter after that. Investors reading into it that their 20% plus growth rates, um, may slow down and maybe even slow down faster than expected.
Yeah, and I think that book to bill is going to come out a little later. The next topic is China, which is so fascinating to me because I think you have to carefully consider your trust levels and what you're going to get out of China. But it obviously is having a huge increase, I think you say explosion, in clinical trial activity going on. And so,
Yeah.
I met somebody last week, a couple weeks ago, is getting ready to start trials in China, and that's where their population is. But I think, how you approach what's going on in China from a CRO perspective might be a little interesting.
Yeah. A lot of the explosive growth that a lot of CROs are seeing in China, it's not necessarily the local China studies, because there are a lot of local China CROs that can and do, run that work. These are when China biotechs need to run studies globally and picking up the global share of that, which could include China. And so, in the commentary for Treya, Icon this morning, several have mentioned it, but the anecdotes that I hear, one or two anecdotes, yeah, whatever. But you start just hearing tons of these, and then when I mention this to other people, I just get a lot of head nodding, and even in the comments to this recap, it's a lot of people saying, "Yeah, I just went to China," or "Yeah, I'm going." Yes, I'm going. It's there. The only conference I go to each year, CNS Summit, they're doing a special first time summit in Shanghai, or sorry, Beijing. Don't don't hurt me, Amir, for saying that. But yeah, Beijing. It's either next month or July, just because the organizer Amir, he went out there. He just couldn't believe what he was seeing. And he's not out there to sell studies. Yeah, he's just out
Right,
there to
right, right.
he's just seeing what's going on out there. So yeah, there's something to it. But again, these are globally run studies, and plenty of the larger CROs have significant staff in China, but it's not necessarily to run local China studies. This is a global situation.
Yeah, and I think it's interesting because if you can go snag a global study, just go snag one. Like it's easy pickings. But if your BD team should not be ignoring what's going on with the Chinese biotechs on the global scale and not
Well,
just
hey,
local to China.
for some of them, it is easy pickings. You just got to show up. Got to show up. It's not fun. I'm not going out there. I'm not traveling out there. I've got no interest to do so. But if I was a BD leader at really any size CRO, I'd be out there.
Out there. Take note, BD people listening. IQVIA, great quarter.
Yeah, yeah. Capitalized, bold, italicized, great quarter. And I'm smiling now because like you read the transcript in my case. I usually don't listen to them live. And Ari, their CEO, I mean, he's just getting pounded over pass-throughs. And you can tell he just wants to like reach through the phone and punch somebody, as did I. Like I wanted to reach the transcript and just punch some of these guys. It's low pass-through revenue. Who cares? I don't care. Nobody should care. It was part of this. Well, is that a potential read through? Like it's this analyst term. Is that a read through that demand could be softening? Like is this a canary in the coal mine that pass-throughs are softening? No, pass-throughs have been out of control high for the last 12 months. So to me, this is some reversion to the mean. But at the end of the day, I'm already talking too much about it. It doesn't matter. It just
Yeah,
doesn't
it just
matter.
I land where you land on pass-throughs are not really great revenue indicators or should not be part of the revenue, and it's a whole mess. So I agree. So we're going to pop off that. We're going to talk about AI and what was going on with IQVIA, because if you read through this, your recap, and I didn't read through the IQVIA call, but IQVIA is positioning themselves to gain revenue off of
Yeah,
AI. And
yeah, yeah.
then they quote, he has a quote on the next slide, the CEO, where there's zero impact from AI in their bookings, and they're not losing any work due to any AI agents. I kind of want to know what look you thought his face might have had, and let's talk through how these two statements are not as contradictory as they might seem.
Oh yeah, yeah. I imagine he just had like this snarky, sarcastic look on his face, which is what I would have had answering that as well. So it's I appreciated it. It does sound like a contradiction, but with IQVIA, IQVIA is not a CRO. IQVIA is two primary businesses. They have their CRO, which they call Research Development Solutions (RDS), which is huge.
Right?
It's an absolute huge part of their business, but they have their technology, their commercial technology solutions. I'm not calling it the right thing, but they have their large commercial business, and that is selling data products, selling technology products, selling related, commercial services. So commercial for already, for existing marketed products. And not many CROs have that. Syneos has a significant commercial business, um, but not many do. Icon had a large data solutions business. They just sold it off. So So when you look at the opportunity to improve financially with AI, when it comes with most CROs, it's the efficiency play. It's a way to reduce costs or to do more with less, or to do what Meta, Facebook was able to do in the last 12 months, where they were able to grow their revenues like 30% plus 30 plus percent without increasing their headcount. So it's the efficiency side of it, but not on the CRO side, being able to sell new services. There's not much of a revenue play there. We have data management, stats, safety, project management, et cetera. You're not really seeing a new service area pop up around AI. It's about being more efficient, improving your profitability, doing more with less.
Yeah, and I think
IQVIA
that just
has IQVIA has the commercial side of their business, where like other software companies, they're able to provide new solutions, new offerings, new consulting services around AI. And so that gives them not just the efficiency play on their CRO, but revenue upside on the commercial side. And so the point I was trying to make is that they are unique as a company in our industry in being able to get that potential revenue upside, through these technologies. And when you can get that revenue upside, that allows you to invest even more aggressively in the aspects of automation and AI that allow you to be more efficient on the back end. If your only return on investment is through better efficiency, that really caps how much you can invest into those initiatives. So it just really stood out to me this quarter as almost like a light bulb moment, even though they've been saying it for multiple quarters. It also
yeah,
stood out to
right.
me that Icon sold off their data business. So it's fascinating.
Yeah, I think So I was going to say, yeah, you can never invest more than what you're going to save from being efficient. Otherwise, you now have a losing. Now you're losing money on the whole deal. So IQVIA is going to get some benefit there. For me,
It's also made us also a lot harder to. It's a lot easier to prove that, hey, we invested in AI and we were able to sell $500 million more. We were able. I can. It's much easier for me to prove that I have $500 million more revenue because I'm selling these products than it is to say, oh, I'm $100 million more efficient.
yeah,
How do you prove that?
it's going to come down to something around margin. But I think that there's a lot of. I'm not saying AI isn't doing great things and isn't making things more efficient and isn't impacting data activities. There's still a lot of hype around what's actually coming through on the efficiency side and what that looks like. And that is a whole different conversation. But let's talk about
I'll tell you one
icon.
thing it is absolutely doing is helping a lot of companies outside our industry massively increase their revenues. Whether you're
Yeah.
talking about the NVIDIAs of the world, we could go down a long list. Yeah, it's hard to prove that it's making a lot of companies more efficient, but we have all these now. We have so many $1 trillion companies now, and a lot of that is through the revenue upsides they're getting on AI. And so it's hard for a lot of companies in our industry to take advantage of that. So when one is able to, I got to pay attention to that.
Do you think that, well, before we get to icon, because you said IQVIA is going to be able to could potentially distance themselves from a lot of the other CROs. So like, could we
We'll
see
see.
a real shakeup in the large CROs around
I don't know.
what they're able to deliver?
We'll see.
Yeah.
On my radar. Yeah.
Okay, so let's talk about icon, because when you put this together, I don't even think they'd announced their call, but then they
Yeah.
just had their call.
Yeah. They just had their call. So they restated their financials last night. It's a very long read in terms of the restated financials, and then they had an almost 90-minute call this morning. So it's a lot to listen or read through. I did get to read through it. So and I'll do a whole separate thing on it, but their stock is on fire, at least when I checked this morning. So I think the best way I try to sum it up right now is that the worst case scenario is certainly off the table. They had a very small revenue restatement for each of the past 2 years, and that was really timing. It's not like they had to subtract revenue and it's gone forever. It's just revenue that was taken too soon. Especially, anyone who's got any experience with CRO finances, we work on this percent complete type model. Basically, their percent completes on too many projects were too high relative to where they should be. And so a lot of that revenue just gets pushed back into this year and beyond. So on the revenue side, very little. It did not. There appeared to be no fraud or anything like that. A sign of fraud would be if their cash flows and things like that were misstated. They were not. Just as importantly, perhaps most importantly, they found no errors or issues around their customer finances. So that's obviously good. You would not want to see things like, oh yeah, we actually have been charging our customers more for our pass-throughs than we were actually incurring. So no funny business there. So a good result from that standpoint. The backlog new business side is where things were really messy. They took a $4 billion negative adjustment to their backlog by just stop me if you don't want to go me to
No,
go
keep
all
going,
into it.
keep
But
going.
their current bookings policy, they were having their cake and eating it too. They were trying to have it both ways. Where on the front end, how you count a new award, they were taking it the minute that email came in from the customer saying the study is yours. Well, not all new studies stick, right, Amanda? Sometimes they cancel out. But then what they were doing on the back end is if an email came in from a customer saying, hey, we're going to terminate this project, they would not recognize that cancellation until like the final closeout agreement was signed, or the termination agreement was signed. That can take months. In some cases, this accounted for over 75% of that $4 billion adjustment. In some cases, those termination agreements never happened.
So they never
Never
took it.
happened. So they never took it. And so they said over 75% of that $4 billion adjustment were from studies started in 2023 and before 2023 and before. So it was just dead backlog. And so, you know, the irony is that their stock has been getting pounded over the past year because their burn rate is really low. Well, yeah, their burn rate is low because they had a bunch of dead backlog in there. I think it's something that a lot of analysts just knew, just inherently knew, but you never knew. It was four billion. That was like 20% of their backlog. It was very significant. Yeah.
So I'm going to ask you a follow-up question, but just to kind of assemble it, because we were talking about something going on in the early 90s earlier, but like, I remember when companies started doing $1 billion in revenue,
Yeah.
right?
Yeah.
And now they are carrying billions in dead backlog. But Icon is putting some changes in place in terms of how they are.
So they're not changing things on the front end. They'll still take that email. They'll take the email, and it's pretty loose, Amanda. The two criteria they mentioned on the call is that they will take the email if revenue is expected to start within 12 months.
Ooh,
That's very
that's a
lenient.
long time. Yeah.
It's a long time. Uh, we could get into comparisons, but yeah, that's very lenient. And the customer has to have funding. I mean, that's pretty obvious. But that's 12 months, so still very lenient on the front end. They had said their big problem was on the back end, and so now if that cancellation email does come in today, they will book that cancellation this quarter. But then where it starts getting squishy, and everybody has to deal with this is, well, what if the study's been on hold for 6 months and you can't get a hold of the customer? Believe it or not, people, biotechs do that.
Yeah.
They do that. What do you do then? They say, well, we'll be conservative and we'll take it out. But and I'll post about this. There's like a 2-minute part where Barry's talking because he's being asked about different scenarios, and I think they're going to run into a lot of volatility, a lot of issues around still taking new awards off emails, but then stuff goes on hold or delayed. They say they're going to take them out, and it was basically a trust us. I don't see it.
Yeah, it's a hard one. I mean, even the 12 month, well, a couple thoughts. One, I know you're a proponent of get the contract signed or get something signed before you are taking that as a booking, and I kind of agree. But 12 months in general is a long time, and a lot can happen in 12 months, right? They could lose their funding, the study could be canceled, the study could be delayed. And when does it cross from being within that 12-month window to being on hold, which should come out? And hand waving and trust me is, a simplification, but it is also kind of a bit of a challenge. It'd be interesting to see how they do and how they carry that forward.
Yeah, I expected a stronger stance because in their audit committee's findings, one of the main reasons for the accounting issues was an improper quote tone from management, and that the reasons around their lack of internal controls and things like that was quote tone from management. So I'm not saying Barry got on the call this morning and gave an easy tone, but the policy is still very easy on the front end, and I expected something tighter. We'll see. Well, not we'll see. That is what it is.
We'll keep an eye on that and see what it's looking like.
We'll see how well it works out for them. Yeah.
All right, Thermo Fisher, also known, I guess PPD, also known as Thermo Fisher.
Yeah. I mean, there's on the software side of business as a whole, not just our industry, there is an obsession for good reason with annually recurring revenue, ARR. That's why I capitalized it. And it's just this idea that you sign a $300,000 fixed fee subscription. It runs year after year. You book the same monthly amount for revenue month after month. It's this beautiful thing, right? And it is beautiful at scale. But I just always remind myself, and I appreciated how Thermo Fisher called it out for services, referring to services as recurring revenue. And it is, you look at a CRO grid, whether they're invoicing on that basis or not, and it'll say something like $61,245 for 48 months. It might be broken up into different periods, but to me, that's about as recurring as it gets. And you say, well, 48 months, it's not forever. Neither are software subscriptions. Ask a lot of software companies about that.
I mean, 4 years is a good bit of guaranteed revenue there, and I think that's I would stretch that out to say that's the appeal of the FSP business, right? You've got some guaranteed work for your team for the length of that FSP. And you can say, well, they can cancel or they could do whatever. Well, that happens with everything. So it's kind of a non starter for me. But I think that's why you traditionally can get a better deal on FSP resources than a project-based outsourcing, because it's guaranteed income for guaranteed revenue for the CRO providing them, which gives them a little bit more flexibility.
Yes, on a rate-to-rate basis, yeah, it's typically lower because the CRO is getting that more guaranteed payment. The flip side is you as the buyer, the sponsor, the buyer, you have to make sure you're actually really good at resource management to keep those people busy. Otherwise, you'll end up paying more. Yeah. Oh yeah, so I thought that was really good of him.
Yeah, it's a good point. It is a little bit of a shame now that PPD's wrapped up in Thermo Fisher. I think it's not as clear how the CRO side of the business.
Yeah, I think it was a great buy by Thermo Fisher. And someone asked me why I didn't write about Clario. There wasn't anything new to report this quarter about it. I just, wanted to give Mark Casper some kudos over what I thought was a great statement here. This was actually at their investor day last week and not their quarterly earnings.
All right, complexity is opportunity, and this was something that was noted by Thermo Fisher.
Yes, I mean, it's noted by everybody, and everybody on the ground level knows this. I am not a scientific expert by any means, so I'm not a protocol expert. But protocols, this is a long-term trend. That clinical trials and the protocols that govern them are becoming more complex over time. And my take is that that's not changing. And what really stood out to me this quarter was there are good reasons for that. And we all want things to be simpler. Sometimes that's just not possible. I was mentioning trillion-dollar companies a little bit ago. You think what NVIDIA does is simple? You think what any semiconductor company does is simple? I don't even know. If you put a semiconductor in front of me, I wouldn't know what it looks like, let alone how to engineer it. Now, the goals of those complex products are to make our lives easier, right? So it's easy for me to move around to what I need on my phone, but there's nothing simple about how this thing is built. And so, with complexity is an opportunity. I don't mean that in a crass, go max out your revenue and squeak every dollar of profit you can out of that complexity. I'm not saying to use it to your advantage in a devious way. It is the case. And don't try to tell your customers that something's simple that's not. Tell them it's complex, and tell them that you're equipped to handle that complexity and charge them for it.
That is something. It's a message I carried through into a bid defense meeting, because we were working on a complex project, and the person knew what it was, but they had never done one. And the information we were pulling together was really complicated and complex. And in some cases, it was starting to get presented in a confusing way. I mean, perfectly reasonable for the team that would do it because they do it every day. Confusing for someone who doesn't even know what the steps are. And so, the message is, it is complex, it is intricate, there are a lot of moving parts. We know how to navigate them. We can make it, I guess easy, but we can manage that complexity for you. And there's the opportunity, that having that knowledge of how you are navigating 37 different data sources and complex study visits and components around the trial. And that's the place for how you can convey how you can manage that and how you can prove that you can manage that, as opposed to just, anybody walking into a bid defense is going to say, of course they can manage complexity, but that's how they win their studies.
Yeah, I helped build a pricing tools a couple years ago that allowed for up to 10-part studies. It wasn't fun, let me tell you, but yeah. Not saying those are super common, but it's all to the point that complexity is increasing, not decreasing. We will over time have more 2 and 3 and 4-part studies, not fewer. Yeah.
Let's talk about Fortrea.
Yeah.
So you're saying they need to get a handle on their write-offs. What are they writing off? And
these are invoices, invoices and/or amounts that they had previously booked as revenue that they needed to write off either due to percent complete issues like we talked about before, or or maybe they're invoicing it on a unit basis. You get to the end of you get to the end of the study and you had recognized more revenue than you actually got paid for. So it's a variety of things, but the scale of it, $7.3 million in the world of a large CRO does not look like a lot as a percent of revenue. But you start going down what it's a percent of or other parts of a CRO's financial health, and that's much more significant. So if you looked at that as a percentage of gross profit, it's going to be a much higher percent than it is of revenue. Everybody talks about EBITDA. I think it would have been about 20% of EBITDA. That's a lot.
That's,
But this is a publicly traded company where investors look at earnings per share, net income per share, the bottom line of what's attributable to me as a shareholder. And yeah, it was almost half, which is a way of saying that their earnings per share would have been almost 50% higher if they can get a handle on these write-offs. It's not a one-quarter thing. They've been struggling with it for some time. They've been upfront about it. I love all companies in our industry. I follow this company. I used to work for one of its predecessors, Chiltern. I want it to be successful. So this is me cheering them on. Like, get a handle on those write-offs. Stop the bleeding there. Yeah.
yeah, well, Fortrea has been through so many iterations. I think I've worked for one of their iterations in the past as well. But I would like to see them stabilize. I think just because of part of their history, and they are a large CRO, and it would be nice to see them navigate their tumultuous past few years.
Yeah.
I
And
guess
they have stabilized. I love their new CEO. And I don't know him personally, but he's doing a great job. And I think the last point on this was that so I always go and I look and I say, well, how much is IQVIA writing off? And so it was immaterial. Like, they didn't even put a number there
yeah.
because it's just immaterial. Same for several of the others. So to me, that's an opportunity, right? It's an opportunity more than a blaring red flag for the future. But we'll get into some technical financials here. But when a CRO on a contract earns more revenue than they've been paid to date, that goes into a special category on their balance sheet. And Fortrea's number for that is, on a proportional basis, is much higher than its peers. And one of the ongoing concerns is have they recognized a lot of revenue that's eventually going to get written off?
Yeah.
And we'll see. I don't want them to have an icon situation.
Speaking of Fortrea CEO,
Yeah.
what did he say?
Yeah. Oh, I'm not going to tell you. I'm not going to tell you. Because it was so good, and nobody's going to see it except mostly the investor analyst community. But he said a lot of great things, and I'm a big advocate of companies like Viva, Palantir. I could go on down the list. And Tempest AI, a company in our industry, who, as part of their quarterly earnings package, provide a shareholder letter, typically with the CEO's comments on the quarter date. Anybody in the world can see if you go to their investor relations page. Instead, what way too many companies do is they get on these earnings calls and they give these really long prepared remarks, just verbally.
Yeah.
And unless someone posts it on the internet, nobody's going to see it. Nobody's going to see it. And some of these letters, right? I mean, I look at them like, they're such good marketing opportunities. They're not salesy or anything like that. They're excellent to say, hey, here are the things we achieved this quarter. Here's all the good stuff we're doing. Some great case studies. Stuff that Fortrea's CEO gave on the call. And I'm like, this is such a great pitch for the company. Nobody will ever see it. Nobody will
Well,
ever see it.
I'm going to try and track it down and link it when I post this out.
No,
But
don't. No.
no, okay, I'm going to find it
That's the
for
Fortrea.
myself
Yeah.
and read it. But Fortrea, got
That's
some
why I
free
said
marketing
sadly.
advice
Yeah.
courtesy of Joel White. So maybe take it. So
Doesn't have to be that way. Yep.
Fortrea has clinical pharmacology business, and
Yeah.
they're
Yeah.
branching beyond healthy volunteers, which is fantastic.
I had heard of something like this, a mid-sized CRO in my universe who has at least one early phase unit in the U.S., and they do a lot of rare disease work. And in specific cases, they will dose a patient at that clinic. That will be the site. But I just wasn't hearing about it much. So this, to me, it's like, wow, here's another example of doing that. I don't see it much anymore, but um, you just sometimes get this this theme or this take that because CROs are doing healthy volunteer studies, those aren't real sites. They're not real sites. They're not running phase 2, phase 3 work. They're not doing phase 2, phase 3 work unless it's the sites that, like the kind that ICON and IQVIA flat out own. But this was just a reminder, to me, and obviously I put it out there that CRO sites, they're doing a lot more than just running vaccine trials on college students. They're starting to do some complex work there. Further evidence that the early phase side, ICON talked about it this morning. They just opened up a massive new beautiful facility in Texas, I think San Antonio. And the reasons they did it, just using ICON from this morning, they see really significant long-term opportunity in early phase, and so they're investing in it. IQVIA now owns an early phase site in the UK. I believe the first they've done that in a long time, at least since the Quintiles days. And they bought an early phase SMO back in September. So there's just some real strong investment in the early phase cycle. And I think the timing is good because there seems to be some real momentum on the drug discovery side that presumably will put a lot more candidates into the early phase clinics. So here we go.
All right, let's talk MedPace, because there was quite a few things on here that they have a bad book to bill, and they have they also where did I lost it? They're also having some cardiovascular distress. I think it's actually after the Satara information.
Air quotes bad. Air quotes bad. Yeah. Book to bill is a fraction, which I don't know. Some of the publics are publicly traded CROs are saying that's a bad metric. Then I'm like, why do you still put it in your reports? But it's because analysts look at it. Book to bill is a fraction, and it can be a fraction on a quarterly basis. It can look at the last 12 months. It can look at any time period. But the numerator, top of the fraction, is your net new bookings, net new business in that time period. We'll just say quarter, in that quarter divided by your revenue in that quarter. And so more often than not, you want to be bringing in more new business than you actually earned in revenue. That will continually increase your backlog over time. So think of this, your backlog is like this mountain of new business where there's always stuff going in to raise the mountain. This is not a great analogy, but or like a swimming pool, right? You're putting stuff in to increase the water level, but you're always earning revenue that comes out of the backlog. And so it can be concerning if in a particular quarter, but really over multiple quarters, you are more revenue is going out than new business is coming in. So in this particular quarter, Q1, MedPace had a 0.88 book to bill, which means as a fraction, it means the numerator was smaller than the denominator, and so that is quote unquote bad. But that really you have to take into context how the rate change of the denominator. And so if your revenue, that denominator, if your revenue, like MedPace, is growing 20% plus per year, that means your new business has to be growing at like 30% a year to have a positive fraction. So it just suggests that their growth rate is slowing down a little bit. It does not mean, which is what I used to think back in the day, it does not mean that a book to bill less than 1 means your revenue will go down. Not at all. It just means that a 25% growth rate might go to 24, 23, 22.
And I'll just point out, because I found this really interesting, that MedPace is being sued over their bad book to bill. So we'll just glance over that.
I didn't even want to put I should not have even put the link there. I had a feeling some people wouldn't even believe me if I said it. So
you got a link. Just because you say it on the internet isn't true. So Tara made a sale this quarter.
Yeah. I put this up for a couple reasons. One, I mean, it's big news. In the world of regulatory and medical writing, $50 million a year of revenue. That's a big business
Good, yeah.
service area. Certara is a company I follow. They had announced their intent to do something with the business 18 months ago, and so when the 135 was announced, people were like, "Wow, that's a really low valuation." Well, a couple points here. One, it might not be 135 million. It's 100 million guaranteed. Basically, 100 million is paid, but 35 million of it, that business has to reach certain financial milestones over some future period of time. I couldn't tell where it was disclosed. It might have been. If it was, I missed it. And so it's really 100 million valuation for a $50 million a year revenue business. And so, we can often get obsessed over multiples. What multiple did you sell at?
Yeah.
Oh, your multiple was lower or higher, or your multiple should have been this. Well, that multiple will depend on how much debt you have, not really a factor here, and your growth rate. Two companies
Yeah.
two companies making $50 million a year. Well, one, how profitable is that 50 million in revenue? Is that 50 million in this case? Was it 55 the year before, or was it 45 the year before? Are you going up and to the right, or are you going down and to the right in terms of your growth chart? It really stood out. A couple things stood out to me. One is just the free fall in revenue performance. That was a tough time for a lot of companies in our industry last year. So industry softness accounts for part of that, but not Q4, not Q4.
Yeah, I mean, I really, the comment around them saying they're selling it, so it's no longer a priority so long before they sold it,
Yeah.
and really,
They first mentioned it, I believe it was in their Q3 2024 earnings call, which was in late 2024. And so when they said that, I was like, oh, something's imminent. And it wasn't. Like, how do you say that publicly, that this part of our business is just not that important to us, and then you let that happen for 18 months? What do your customers think? Your customers know what your plans are now.
Well, I mean, I think you can see that, that kind of hit their revenue. I'm just going to highlight this one, and then we'll move on, because I found
Okay.
this interesting. We were talking about AI before, that evidence of the actual agentification of CRO process of any kind at scale is still lacking, and that is very much in line with what I hear talking to various people.
Yeah, well, let me pause you though, because literally, Amanda, after I hit post on this recap, I'm not joking. Literally, I hit post, I refreshed my feed, and the first thing I saw was Viva's Falcon announcement. And that doesn't mean that it's a scaled agent ready to go today and take over all your processes. But I think that there's going to be a lot of people. I'm talking about like day-to-day ground level people in our industry who, for the first time in their careers, particularly as they're interacting with their eTMF, where Viva is dominant. I mean, there's no question about that. They will start interacting with agents at scale in their own workflows, their day-to-day workflows, not helping me draft an email, not meeting minutes from my team's call. Like, I have an eTMF process, and an agent is fully part of it. I think that's going to be, I just don't know when, but it's a milestone in my world. Yeah.
And I think the eTMF is a great place to start personally to do that. But since we're talking about Viva, let's have this, because when I went through this, I noticed there were two companies not mentioned, Medidata and Viva, and I was a little sad, because I had a question all prepared to ask you about that. And
Still ask it, yeah.
I am going to ask it, and so I would like to just say, one, as you answer, tell us why Medidata and Viva were not in here. I think Viva would have been if the Falcon announcement had come out a little sooner. But when I talk around to data people and we talk about what's going on, and we have been talking for a while, so who knows when we'll get there. But the day when maybe you don't need an EDC anymore, and so for me, the question becomes, what about these big companies that are built on their EDCs, and who's best positioned to kind of transfer to a world without EDC? And I was specifically wondering about Medidata and Viva.
Yeah, well, a couple things. One, I would prefer to ask that question back to you, yeah, around some of the structural implications, because I'm just not an EDC. I know what it looks like, but I'm not a pro in it. So let me answer the first part of your question, then I want to put that back to you. Why no metadata or Viva in this quarterly report? Some of it is timing. Viva's earnings release comes out next week. They have I believe, a February to January fiscal year. So so they're off a month in terms of timing when they come out. So I just didn't have it in time. I tried to wait for Icon, and then
Yeah.
once I had it ready, just like the Viva situation, I finished it up, and then Icon said, "Oh, we're going to report the next night." So, anyways, I didn't have really anything fresh to put out on Viva. I would have put Falcon in there if Peter, their CEO, had given me the heads up. Not that he knows me, but it's like, oh,
Next
Peter,
time I'll
where's
have you on
just give
speed
me a heads up,
dial.
man. Yeah, give me a heads up. And then metadata, I didn't have anything to say. It was the same, -3 or 4%. That's adjusted for currency.
Yeah.
In actual, not adjusted for currency, they were down 12%. Now currency has been a major factor, but I'm like, there's some there's some issues there, but nothing new. So I have a placeholder every quarter for them, Amanda, and I didn't have anything. I didn't have anything this quarter. Fun fact: in 14 hours from now, 1 a.m. my time, 1 a.m. my time, I will be presenting at Viva's EU R&D Summit in Copenhagen virtually from my global headquarters here at 1 a.m. So I'm hoping to learn some more about Falcon and their releases.
Yeah, I'll look forward to hearing what you say, and way to take one to be up at 1 a.m.
Well,
But
it's
I
their
think like,
breakfast. It's their CRO breakfast. So, it's in Copenhagen. Yeah.
I'm trying to think how many hours that's going to be, like 7 or 8 a.m.
I think so. Yeah. Yeah.
So, but who's best positioned to move into a post EDC world?
I don't know. I don't know. You would have to first convince me of a post EDC,
So I
and I would need to see. No, I would need to see. I would need to see evidence of it, and that's just how I am. I'm not a Nostradamus like future looking person. Nothing against people who are. We need probably a lot more of those than folks like me. I try to stay much more real time, grounded. Got to see it to believe it, and that means there's things I miss, but that's fine. Yeah.
Yeah, and you asked me, and I can imagine it, but I have a hard time thinking about how we get there, only because people talk about it because can we get from the source to some sort of standardized database, because we have standards that exist, right? How do you get from source
Yep.
to SDTM, for example, or but not everybody uses eSource, and then there's privacy concerns globally, and the standards differ. Sites have to be enabled to do that. If how does that fit in the world where we want to have more um, let's just say community-based sites where it's easier for people to access trials who may not have that infrastructure to feed into something. Also, what's the source of truth is always an interesting component for me. Of you have multiple data sources, they're all going to have patient identifiers, but obviously things do not always line up as neatly as you would like. So how are you navigating through that? I do think something has to be done, and something will happen in order to streamline data acquisition and how it's going. Um, Probably we need to think beyond the EDC, only because
Mhm.
processes around data have not changed, just like who's doing it. Like EDC is a classic example. We didn't change anything except who does the data entry, and now it's at the site instead of at the CRO or the sponsor. So I think it will change. I'm not sure where it actually ends up, and I think that there are technology and privacy infrastructure items that have to be addressed.
Yeah, yeah. So for me to believe it, I would need to see companies like Viva and Metadata talk about how, yeah, we're going to have to retire it someday, or it's being replaced by this, or
Yeah.
it's an existential threat to our business. And that's what I would need to see to start believing it, let alone to fully believe it. So again, that's where, you know, I, I would not be the first to predict it, like me
Yeah.
personally. So
Yeah, the
it's
other
fine.
part that makes it a challenge for me is because I always think things through a CRO lens, and CROs follow, they don't lead. And so a sponsor is going to drive some sort of change around that data acquisition process if it's going to come in. I wanted to understand.
Yeah.
I'm like, okay, I don't even know what this is.
All
So
right.
what are we doing here?
All right. Yeah. This is for like my pure finance folks out there, not just finance. This is like treasury management, very specific stuff. But okay, so let's say, Amanda, you are a CRO or any service provider, and you are so excited because you got your first large pharma deal, right, $1 million contract. And you get the MSA, and they say they will pay you in 120 days after you submit the invoice. And $1 million isn't so exciting anymore,
Yeah.
is it? Especially if it's a lot of work you have to deliver, maybe even cost you have to incur ahead of receiving that money 4 months away. So what factoring is, it goes by different names, is either the pharma often will or may have a program where they'll say, hey, we're going to pay your invoice in 120 days, but we have a program through Chase Bank or Goldman Sachs or whomever where Goldman will pay your invoice in 5 days to you. You will take a 1 or 2% haircut on that. And so your $100,000 invoice, you'll get paid 99,000 or 98,000, but you'll get it in 5 days. And then the large pharma doesn't pay Goldman until 120 days, right? Now, I mentioned for that $100,000 invoice, you get 99,000 or 98. Sometimes it could be 97, 96, 95. It depends on what interest rates are in the general market, things like that. And so to see how much a program like that costs for Treya, who needed a program like that a couple years ago for different reasons we can get into or not, versus what IQVIA, who doesn't need it. It's like if you're in really good financial situation and mortgage rates, drop a lot, like, well, I don't need to, but that's a good opportunity, right? You want to
Mhm.
be in that driver's seat. And so it's Fortrea had to do its program when rates were kind of at their peak, and it's costing them a lot. And because they didn't have great financials then, it's just like not everybody's going to get the same mortgage rate, right? It depends on your credit history and things like that, your overall financial situation. It just really stood out to me how much Fortrea has to pay for a program like that. It's like incurred through interest versus what IQVIA does. Yeah.
Now I learned something. I'm
Yeah.
gonna book through because we're almost out of time. So
Okay.
just showing I could talk about this stuff forever. Chubb, which is like, oh look, we
Yeah.
have an
Yeah.
insurance company
Yeah, I
company
got a
here.
heads up on an announcement, and I was like, what the hell is this all about? Chubb, they insure like freighters and stuff like that, but they are one of, if not the top insurer of clinical trials in the industry. And so this particular announcement, I don't know all the details, and I don't know I don't know VCT very well here, but it's a way that if you as a sponsor can prove you're taking additional steps to eliminate professional participants, duplicate subjects, and things like that from your clinical trial data, and I assume there is some kind of a policy or rate benefit. But this was very unique. There could be a million other things like it. I have no idea. It's the first I'd come across, and so I was like, okay, Chubb is on the recap this quarter.
Here we are. I love this story, and just because it's like watching a train wreck.
It's my best work. Yeah, it's the best. It's the thing I'm most proud of writing. Yeah.
And
Cool. Yeah.
consulting, I thought, was an interesting component because it's supposed to be highly vulnerable to AI. I personally don't think it is, because I think that's the human in the loop is kind of that consultant in a way.
Yeah. Hey, look, this is one where I would be among the first to know if there's a big impact, because it's what I do for a living. But where it stood out to me was IQVIA was talking about the strength in their commercial business. We talked about the two parts of their business, and within that, yeah, there's data products, but there's also just consulting services that they provide to a number of different types of companies, and they have a record pipeline. And they talk about how, hey, AI is supposed to be disrupting this stuff, but we have a record pipeline. I was like, well, so do I. So, it's,
I think people get a lot of
yeah,
information out of AI, and then they don't know what to do with it. And that's where the consultant is going to
yeah,
help them. Okay, and you've got a few things going on, Joel.
yeah, yeah.
So
It's us today. The second bullet is me tonight, 1 a.m. my time. And yeah, I got a cool webinar coming up with our mutual friends at
yeah, yeah.
BioForum. And then we mentioned Science 37, the writings 5 years ago. gosh, I wrote some cringeworthy stuff back then, Amanda.
So if you're having, want to go read the end of your week, go read the
Yeah,
comments associated with the recap on LinkedIn
yeah,
and go check out Science 37's history. I will be joining your webinar because
great.
two favorite people that I want to listen to. So I'm looking forward to that. Thank you so much for going through this with me, Joel. It was a great conversation. I really appreciate your insight.